Yeah, I mean, look, that's a great question because, I've been doing it for 34 years. Every single deal has its own unique impression that it's left with me. And, that's what makes me a very difficult buyer of real estate because, anything and everything that could happen has happened to me. I started in my career in the early 90s, and the capital markets and financing was extremely difficult. And I spent, a lot of my time early in my career representing very large private real estate companies, and they really only had two choices. And banks did not want to lend money. So you either had to go public, file a public registration, because banks understood that it was a better bet to lend money to real estate investors when they had public company transparency to the financials with lower leverage on their assets that they were acquiring. Or their other choice was really to go broke, sell off the assets because the banks didn't want to renew the loans. So many of the largest industrial public REITs came out of Chicago. And those were the people that I was working with to execute on the same strategy that we're doing right now.
Mm-hmm.
We acquire the assets, we aggregate them to scale, and then in their case, they already had the public registration, or they were putting together the public registration. And the common way that real estate people do it is through UPREIT structures, where you essentially incubate all of these assets, get them to scale, while the same advisor is working on getting the public registration. And then once you get to scale, once the SEC buys off on the public listing, if you will, then there's basically a swap. And then those assets transfer into the public vehicle, and those that contributed those assets exchange their equity for shares in a public company. And that public company is a real estate investment trust.